Welcome back, guys. In today's video, we're going to go over your risk to reward ratio and your strike rate and how to use these numbers to accelerate your trading growth. In this lesson, we're going to cover risk reward and strike rate, and what those two things are is your risk to reward is the measure of your potential profits relative to your risk, and strike rate is the percentage of trades that you win. So the relationship between these two numbers, your strike rate and your risk to reward, is going to give you a true measure of how effective you are as a trader. So if the relationship between these two numbers is positive, then you can make it as a trader. Plain and simple. What I mean by that is that, let's say your average trade is a 1 to 4 risk reward ratio. So you risk 1 to earn 4. You would only have to have a strike rate slightly above 25% just to break even. So anything above your 25% strike rate mark with a 1 to 4 risk reward ratio is going to make you a profitable trader. That's going to indicate profit for you. So if you only have to be right 25% of the time in order to break even, if you can get yourself to the point where you're right 30% of the time, you have the keys to make millions of dollars. The key to your success in trading hinges upon the ideas that we're teaching here, not only in risk management, but throughout the whole course. So this is why tracking your progress is so crucial, because the reason why risk is so important is because it's the key to your long-term success. Not just a year, 2, 3 years down the road, but to do this for your entire life, for the remaining however long you want to do it for. You can make a lot of money by over-risking, but easy come, easy go. You can also lose a lot of money too, especially if you're not comfortable with the markets yet and you don't know what you're doing yet. So focusing on risk management at all stages of the game is going to make you, put you in a position where you can have a long, successful trading career. So, like I said, one of your jobs as a trader is to track your progress in these areas. We are going to include a spreadsheet for you that you can use to track various aspects of your trade. And one of these, you're going to be recording your risk to reward ratio. So this way you can always know where to tweak your strategy. So as long as your stop loss and your risk to reward are in positive balance with your strike rate, you'll be able to successfully trade. So the really cool thing about these two things is that knowing your strike rate and your risk to reward ratio on average is going to speed up the time that it takes you to master trading, because your discipline in tracking these stats is going to give you an advantage over the average trader. Most people aren't going to track their progress. So is it possible to be a successful trader without these numbers? Yes, absolutely. You don't have to have a grasp on this concept in order to be a successful trader, but in order to know what you need to improve on in your trading, these numbers are going to point you very well in the right direction. So let's say you have a 70% strike rate, which is awesome, but your positions are only 1 to 1 risk reward ratio. You would be doing very well in the market, but to get even better, you would know that your strike rate is fine, and what you need to work on is getting a better risk to reward ratio. So you might mess with changing your stop placement or changing your profit target, maybe trying to go for more profit or trying to have a smaller stop loss to increase your position size. So as long as you can do these things, as long as you can work on one thing without affecting the other, you can become a really successful trader. And let's take that on the opposite end too. Let's say that you take 5 to 1 trades. You're risking 1 and you're getting 5, but you're only hitting about 40% of your trades. You're still doing really well, but you could get a lot better though. And what you could do is you could tinker with your stop and take profit levels in order to increase your strike rate. So your risk to reward might go down slightly, but an increased strike rate is going to more than compensate for that. So the key to being not just a good trader, but to being a great trader is understanding your risk management and the relationship between your strike rate and your risk to reward ratio. It's about finding your style, about back testing your live results of your chosen style, of your chosen strategy, and it's deciding on where to improve from there. So if one of my students is struggling with their goals, I always ask them for these stats first. I say, what's your risk to reward on average, and what's your strike rate? If they don't know these numbers, then they're not tracking, and they're probably not doing other things well, or other things how they should be either. And it's really hard to determine where to go from there, how to get better. So take the time and have the discipline to track these numbers for yourself. And with these numbers, you'll always know where you stand, and you'll always know where you can go to get better. All right, and so this brings us to the golden rule. You never want to risk more than 1 to 3% of your account per trade, and never more than 5 to 10% of risk at any given time. So what that means is if you have 2 trades on, and both of the trades have a 3% risk on them, that means you're at a 6% overall risk. That means you probably need to stop trading and just let those trades play out. Let those moves happen before you go jumping in and out of other trades. And if you follow this rule, it's going to keep you from falling into a trap that a lot of new traders fall into, and that's over trading. So new traders will learn a couple things about the market and think they know exactly what to do, so they'll be hopping in and out of trades constantly, like 20 to 30 trades a week, which is insane. And they'll do that without any regard to risk, and they get hammered quickly. They lose all of their money, most of them within the first 30 to 90 days that they start trading. So if these traders never learn risk management, then they'll soon quit trading altogether. So if you follow these rules, you won't fail at Forex, plain and simple. Like, even if it takes you 2 to 3 years to learn the market, which it shouldn't, but if it does, that's fine. Everyone's got different things going on. Your risk management will keep you in the game while you learn the markets. So 1% losses are not that hard to manage emotionally. So they keep you in the game, they keep you motivated, they're not gonna just suck your soul out of you. So even with a poor record, 1% losses aren't going to kill your account. You can take the time to learn. You can learn how to do the proper position sizes. And just remember, think about your risk before you start thinking about the money to be gained, and you're going to be a great trader.